Okay, let's unpack this.
Okay.
For decades, when you and I and probably most analysts thought about the Home Depot, the image was pretty clear.
Oh, yeah. The orange apron. The big box store.
Exactly. This incredibly efficient, high-traffic retailer,
Yeah.
serving the weekend DIY warrior just as much as the local contractor. They were the dominant player.
And look, that image isn't wrong, historically.
Mm.
But if that's still your picture of them today, it is dangerously outdated.
Dangerously, yeah.
Because Home Depot's in the middle of this massive, and I mean massive, high-stakes strategic transformation.
Yeah.
This isn't just tweaking the model.
No, this is a fundamental pivot.
It is. Over just the last couple of years, they've effectively bought an entirely new business model. They spent over almost $24 billion on acquisitions.
24 billion.
All to shift the company from being just a pure retailer to this powerful hybrid retailer distributor.
So that's our mission for this deep dive. We really need to get into that transformation. We have to understand the structural pressures that forced their hand.
Right. Why now?
Why now? We need to detail the sheer scale of these acquisitions and then, this is the critical part, really analyze the financial trade-offs they accepted. Especially since they did all this spending in, a high interest rate world.
I mean, what we're watching here is a company that is deliberately sacrificing its short-term metrics. Things like profitability, their capital allocation strategy.
The things Wall Street usually loves.
The very things.
Yeah.
And they're sacrificing them to build what they hope is an unassailable long-term structural advantage in the fastest-growing part of their market.
And that right there sets up the core contradiction we have to grapple with.
Yeah.
Because if you look at the market, Home Depot's stock is trading near a 5-year high.
Huge confidence from investors.
Immense confidence. And yet their actual guidance for fiscal 2025 is, well, it's weak. They're projecting only 1% comps growth.
And an EPS decline. An estimated 2% drop in earnings per share.
So how do you square that?
That gap tells the entire story. The market is not trading on the 2025 numbers at all. It's looking completely through the current cyclical pain. The stock is what they call priced for perfection.
So the valuation already assumes this all works out.
Completely. It assumes total success for this new, nearly $24 billion specialty distribution strategy, even before the recovery happens, before the integration results are in. It's a huge bet that demands absolutely flawless execution.
Okay, so that brings us right to the why. Why did the most successful big box retailer in North America decide it needed to do the 2 largest acquisitions in its history? I mean, why change the whole business structure? Why not just stick with the model they'd already perfected?
Yeah, the compulsion. Really, it comes from a recognition that while their market is just vast, the engines of growth inside that market are changing dramatically.
So let's start at the scale. How big are we talking?
The North American home improvement market. For 2024-2025, the estimates put it somewhere between $500 and $575 billion a year.
It's just huge.
It's enormous, but it's also very mature.
Right, especially after that unprecedented surge we saw during the pandemic years. Everyone was stuck at home. Everyone was remodeling.
Absolutely. That high growth it had to normalize. After the boom from 2020 to 2022, things have moderated a lot.
So what do the projections look like now?
Well, if you look at the Home Improvement Research Institute, HIRI, they call it, they're projecting a pretty modest 2.5% total market growth for 2025.
Okay.
And Harvard's LIRA, that's their leading indicator of remodeling activity, is even more sluggish. They're projecting just 1.2% growth.
And for a company the size of Home Depot, 1 or 2% growth in your core market, that's just not going to cut it. Not for the capital markets.
It's not enough. So if the whole pie is barely getting bigger, you have to ask, where's the strategic opportunity?
Yeah.
And this is where it gets really interesting. Because that overall number, it masks a critical divergence within the market. This split is the strategic justification for the entire pivot.
Okay.
HIRI's analysis projects that in 2025, the professional market, the pro market, is set to grow by 4.6%.
4.6%.
Meanwhile, the traditional consumer, or DIY segment, is only expected to grow by 1.3%.
Okay, that's not a gap, that's a chasm.
It's a chasm.
So Home Depot's traditional model, it's heavily exposed to that slow-growing 1.3% consumer side. To really accelerate, they have to shift their focus squarely over to that 4.6% pro segment.
Precisely. The strategy dictates they have to move their center of gravity. move it toward the faster growing, the higher ticket, and, frankly, the more structurally resilient pro customer.
But they're doing this under some pretty intense cyclical headwinds.
Oh, absolutely.
Yeah.
The dominant near-term factor is, without a doubt, high interest rates.
The famous rate lock logjam effect. Homeowners are just stuck.
They are. I mean, the logic is simple, right? If you have a 3% mortgage from a few years ago, you are financially punished for selling and moving into a new home with a 7% rate.
Right. It kills housing turnover.
It stalls it completely. And housing turnover is traditionally the biggest trigger for waves of home improvement spending. Management has been crystal clear on this, saying the higher interest rate environment is what's adversely impacting demand. It's just keeping people in place.
And when people don't move, they pull back on the big stuff, the discretionary credit-funded projects, your kitchen renovation, the big addition.
Exactly. They just patch things up instead. The mix shifts away from those high-dollar discretionary projects. And that's why we saw the slump in 2024 and why the guidance for 2025 is still so weak.
But you're saying that's only half the macro story.
Only half. The other half is this incredibly powerful structural tailwind that gives the entire industry a remarkably high floor for demand.
And that floor is just the age of American houses.
Exactly. The median age of a U.S. home is now 41 years or older. Think about that for a second. Most homes in America were built before 1985.
And a 41-year-old house needs constant work.
Constant, inevitable investment just to stay habitable, to stay up to code. Old homes break down.
And these aren't discretionary choices. You're not choosing to replace a leaking roof.
They are not wants, they are needs. This aging housing stock, it drives essential non-discretionary investments in repair and maintenance, R&R. We're talking new roofing, HVAC replacements, water heaters, foundation work.
So that creates a baseline of demand that's less sensitive to interest rates.
Much less sensitive. And here's the critical strategic insight. The interest rate dynamic has essentially decoupled that R&R spending from housing turnover. Even if people aren't moving, the 41-year-old roof still needs replacing. And that work, that has to be done by a pro.
So high rates are a headwind and a tailwind at the same time.
In a way, yes. They're stifling turnover. But they're also boosting demand for necessary R&R from homeowners who've decided to, as they say, invest in sprucing up their current home rather than selling. It makes the whole sector far more resilient than you'd think. And it provides the long-term justification for that $24 billion bet on the pro.
Okay, so let's move to the execution. They see the slow growth environment, but they also see the huge pro opportunity. So they launch this transformation. They're moving from a simple retailer to this hybrid retailer distributor.
And this shift is about so much more than just selling different stuff. It's about fundamentally changing their relationship with the pro customer.
Oh, so.
They're moving that relationship from being purely transactional,
Yeah.
A contractor buying lumber and nails for today's job, to being embedded.
Embedded.
Home Depot wants to be indispensable to managing the pro's entire business, everything from procurement to workflow.
And they kickstarted this embedded strategy with the two biggest acquisitions in their history. The big one, the platform acquisition, was SRS Distribution. That closed in June 2024 for a staggering $18.25 billion.
SRS was the foundational piece. It was the move that instantly launched Home Depot into the highly specialized, very fragmented specialty distribution market.
Right. SRS isn't selling hammers in a big box store.
Not at all. They sell roofing shingles, specific landscaping materials, specialized pool supplies. This is the kind of stuff that requires really localized knowledge and, critically, job site delivery. It's stuff that rarely, if ever, moves through a retail aisle.
So what did that $18+ billion actually buy them in terms of infrastructure?
It bought them immediate scale and capabilities that honestly would have taken a decade or more to build on their own.
Wow.
SRS added over 760 specialty branches, a dedicated, highly trained, 2,500-person professional sales force, and this enormous 4,000-vehicle job site delivery fleet.
And that sales force is key, I imagine.
It's critical because they have these established personal relationships with local contractors. They act as consultants, not just cashiers.
And then that acquisition immediately proved its role as a platform when Home Depot followed it up with the next big move, GMS Inc.
Exactly. The $5.5 billion GMS acquisition, which is focused on drywall, ceilings, steel framing, that was announced and then integrated by the SRS subsidiary they just bought.
Ah, so that's a crucial detail.
It's a huge detail. It means Home Depot isn't clogging up its own corporate integration teams. They're using the specialized SRS management team as the scalable vehicle for more consolidation. It shows they're serious about becoming a roll-up machine in this space.
The scale of this pivot, just in terms of market potential, it's just staggering. The SRS deal alone increased Home Depot's total addressable market, their TAM, by $50 billion.
$50 billion. And that brought their new combined total addressable market up to approximately $1 trillion.
A trillion-dollar TAM.
So this fundamentally resets their growth potential. They're not just trying to squeeze more revenue out of the same old big box stores. They are entering entirely new, high-growth, high-margin product categories that used to be dominated by these B2B specialists.
But to make that work, it all has to be cohesive. It relies on what they call interconnected retail, right? Blending the physical stores with this new distribution world through a digital backbone.
That digital platform is the true engine of the switching costs they're trying to build. They're extending their digital offering way beyond just basic ordering.
So what does that look like for a pro?
They're creating this comprehensive procurement and workflow hub. It means offering project planning tools where a contractor can upload blueprints and instantly get a full material list. It includes order tracking, fleet management, even crew collaboration features.
So instead of just being the store where the pro buys stuff, Home Depot becomes the administrative operating system for their entire business.
Precisely. And if they can successfully embed those digital tools, the switching costs become almost unassailable. Why would a pro ever leave a system that tracks their inventory, manages their billing, and integrates with their credit line just to save 1% on lumber somewhere else?
That inertia is strategic gold.
It is. And it's reinforced by integrating this new distribution network with Home Depot's powerful core trade credit program across every platform, retail, digital, and now specialty distribution.
And this isn't just M&A, they're backing it up with significant organic investment. Let's talk about those new distribution centers.
Yeah, this part often gets missed because the M&A deals are so flashy. But the organic investment is vital. Home Depot is building 17 new large-format pro-focused distribution centers in their top markets.
And these are different from the regular store.
Completely different. These DCs are designed specifically to handle the bulky, high-volume items. Think pallets of shingles, massive drywall sheets, huge lengths of lumber. All the stuff that's too unwieldy for a retail store.
So how does that system work with the SRS branches they just bought?
The new DCs act as these deep regional hubs. They ensure high-velocity inventory flow and allow for specialized job lot quantity delivery straight to the job sites. This frees up those 760 smaller SRS branches to focus on high-touch, last-mile delivery, and expert relationship management.
So they know they have the backup.
They know they have immediate access to bulk materials from the main Home Depot supply chain backbone. It's a fully integrated ecosystem designed for both speed and scale.
Okay, so this strategic shift, it dramatically sharpens their competitive moat, especially against their old rival Lowe's. But as you mentioned, it also drags them into brand new fights with these B2B specialists.
Right. If you connect this to the bigger picture, it just strengthens their core advantages. I mean, Home Depot's first and most durable advantage is just sheer scale and purchasing power.
Right.
Their massive leverage lets them get favorable pricing, better terms, and exclusive product lines. Think about their partnerships with Ryobi and Milwaukee Tools.
And the difference between them and Lowe's isn't just about size. It's about operational rigor. The numbers here are really striking.
They are. They absolutely are. Home Depot generates $553.69 in revenue per square foot.
553. Okay.
That is 28.5% higher than Lowe's, which is at about $430 per square foot.
And that's not a new thing.
That operational productivity gap has been stable for decades. That 553 number means Home Depot stores are essentially operating at a pace that very few specialty retailers can even dream of matching. They are constantly moving inventory. This superiority flows directly to higher margins and better capital efficiency.
That incredible productivity also explains why they've been so resilient against Amazon.
Precisely. The home improvement category is just structurally insulated from Amazon disruption. The products are bulky, they're heavy, they have a low value-to-weight ratio.
So they're expensive to ship.
Prohibitively expensive for Amazon's model. But more importantly, pro projects and urgent DIY repairs have that need-it-now factor. And Home Depot's interconnected fulfillment strategy just completely neutralizes Amazon's logistics advantage in this space.
And we've seen a lot of acronyms here. For our listeners, can you just clarify what those key fulfillment methods are?
Yeah, absolutely, because these are essential tools for them. You've got BOPAS, which is buy online, pick up in store.
Right.
You got BOSS, buy online, ship to store, and BODFS, buy online, deliver from store. These options give the customer total flexibility. You can order from the job site and have a crew member grab it or have the local store deliver it immediately. Amazon just cannot replicate that kind of speed and flexibility with bulky goods.
So looking at that traditional duopoly, Home Depot was always the leader, but this pro pivot really solidifies that dominance.
Unquestionably, Home Depot holds about a 47% market share in the duopoly versus maybe 28% for Lowe's. And crucially, the pro segment is now about 50% of Home Depot's total sales.
50%.
That's significantly higher than Lowe's, which is estimated at around 30%. This gave Home Depot both the mandate and the foundation to launch this huge specialty distribution offensive.
And that offensive forced Lowe's into a reactive and very expensive catch-up move.
That's the definition of setting the terms of competition. Home Depot successfully defined the next battleground as specialty distribution, and that forced Lowe's to follow.
And they did.
They did.
Yeah.
Lowe's subsequent move in August 2025, that $8.8 billion acquisition of foundation building materials, or FBM, was a clear, high-cost effort to get back on their feet competitively. HD dictated the terms, and their rival had to pay a premium just to play catch-up.
Okay, so they outmaneuvered Lowe's, but what's fascinating here is that in doing so, Home Depot has massively expanded its competitive surface area. They've stepped out of the cozy big box duopoly and basically started a knife fight with these really entrenched B2B specialists.
They have. By buying SRS and GMS, Home Depot is now competing head-to-head with some formidable pro-first specialists who are going to aggressively defend their turf.
And who are we talking about here?
We're talking about companies like Builders First Source. The ticker is BLDR, and Beacon, which is BECN.
And what do these guys focus on?
They're experts, not generalists. Builders First Source, BLDR, they're heavy into structural materials, engineered wood, prefabricated components, the stuff that builds the structure of the house itself.
Okay.
And Beacon, BECN, they dominate commercial and residential roofing distribution. That's a high-margin, high-volume specialty. These B2B guys have deep, decades-long contractor relationships and specialized logistics, and they now view Home Depot as this aggressive interloper on their territory.
All right, let's pivot to the financials, because this whole ambitious plan came with a massive short-term price tag. Home Depot has explicitly sacrificed some key metrics to get this done.
We have to start with the demand normalization. After that explosive, almost 20% comp sales growth in fiscal 2021, the pendulum just swung hard the other way.
Right.
Comps went negative in fiscal 2024, down 1.8%.
And the guidance for fiscal 25 is still stuck in that trough. Only 1% positive comps and a 2% decline in earnings per share. This really confirms that consumer mix shift you were talking about.
It does. Away from big-ticket remodels toward essential maintenance. It's hitting their P&L statement hard right now.
But they're managing what they can control.
Exceptionally well. Despite high inflation, tariffs, weak volume, Home Depot's gross margin has been remarkably stable. It's holding at 33.4%, and they're guiding it to stay right there for 2025.
That kind of stability is a huge signal.
It's a powerful signal of scale-based pricing power that very few retailers can match. And their adjusted operating margin, guided to 13.4% for 2025, is still best in class for the sector.
Okay, but the metric that really tells the story of the strategic sacrifice is return on invested capital, the ROIC.
This is the clearest financial indicator of the cost of this pivot. Home Depot's ROIC has fallen sharply. It was at a peak of 44.6% in fiscal 2022.
44%, that's world-class.
World-class. And it's fallen to 31.3% in fiscal 2024.
So for an investor who uses ROIC as a key measure of management effectiveness, that looks like a huge red flag. But you're saying this was actually an anticipated mathematical outcome.
It is entirely mathematical and entirely intentional. ROIC is profit, the numerator, divided by the capital you've invested, the denominator. Management has intentionally and dramatically expanded that denominator, the invested capital, base by over $23 billion for the M&A.
While the profit is flat.
Exactly. The profit numerator is temporarily flat or even declining because of macro pressures and integration costs. So they have deliberately sacrificed a world-class ROIC in the short term to acquire a much larger, more durable, long-term asset base. The ROIC will only recover once the synergies from SRS and GMS start flowing heavily into that profit numerator.
Let's talk about the balance sheet impact. The acquisitions went debt-funded, and that new debt led directly to the biggest change in their capital allocation policy in years, the Great Buyback Pause.
The pause of share repurchases in March of 2024 was a monumental decision for them. Home Depot has this very clear three-pillar capital allocation framework. 1, reinvest. 2, dividend. 3, buybacks.
And buybacks have always been huge for them.
a major driver of historical EPS growth. But the SRS and GMS investments made Pillar 1, reinvesting, totally dominant. It demanded every available dollar and all their debt capacity, which forced them to halt all share repurchases.
So that financial engineering engine is temporarily offline. What's the immediate P&L impact of taking on all that new debt?
Well, the new debt hits the income statement immediately through higher interest expense. I mean, even with favorable rates, $24 billion in new debt means hundreds of millions in additional annual interest payments. And that is weighing heavily on the 2025 EPS guidance, even before any synergies kick in. It's a big part of that guided 2% EPS decline.
So what's the plan to pay down that debt and get the buyback engine running again?
Management is focused on using their incredible free cash flow, which was over $14 billion, trailing 12 months, to pay down that debt aggressively.
And what's the target?
Their public target is to get their leverage ratio from roughly 2.5 times debt to EBITDA back down to a target of 2.0x. And they want to do that over the next 24 months.
And that 2.0x level is important.
It's significant. It's often the comfort zone for credit rating agencies, shows financial prudence. Until they hit that target, any EPS growth has to come entirely from operations and M&A accretion, not from financial engineering.
And yet, through all this, their commitment to shareholders remains clear through Pillar 2, the dividend.
Right.
Even with all this new debt, they announced a modest 2.2% dividend increase in February 2025.
And that 2.2% increase, while it seems small, continues a 16-year streak of annual dividend growth.
That's a powerful signal.
It's a huge signal that the board is confident the company can generate enough cash to comfortably cover and grow that commitment, even with the higher debt and the lower ROIC. They see the debt as strategic, temporary, and totally manageable.
Okay, so we've covered the pain, we've covered the spending. Now let's try to synthesize these two contrasting realities, the massive investment and the short-term financial hit, and connect them back to the stock's really high valuation.
The market is clearly looking past this trough performance, which raises the question, right? Why is a stock that's guiding for negative EPS growth trading at 26 to 27 times earnings?
Exactly.
And the answer is that the bull case is just immensely powerful, and the market is fully 100% betting on its success.
So let's lay out the three pillars of that bull case for outperformance. What's number one?
First, you have the transformative moat thesis. Investors believe this new pro ecosystem creates those unassailable switching costs we talked about, the digital platforms, the embedded workflow, the synchronized credit, and that this will unlock that $1 trillion TAM.
So it's seen as a lasting structural advantage.
Exactly. One that will drive powerful, defensible growth for years, post-2026.
Okay, pillar number two.
The macro rebound thesis. This is the external catalyst everyone is waiting for, the current 1% comp environment. It's viewed as a temporary trough that just can't last forever.
The coiled spring.
The coiled spring of pent-up demand. The market is convinced that lower Fed interest rates are the #1 catalyst. When rates finally fall, all that demand for large, discretionary models that's been delayed for 2 years will be unleashed. And that recovery will combine with the new M&A earnings for an exponential wave of growth.
And the third pillar is just a fundamental belief in the company itself.
Exactly. The best operator thesis. The market trusts Home Depot's superior operational DNA. You see it in that consistent 553 per square foot number. And it trusts the long-tenured management team, led by a 20-year company vet in Ted Decker. The belief is they will successfully integrate these acquisitions and take market share no matter what the cycle looks like.
That is a compelling long-term argument, but let's be the skeptic here. Given the sheer scale of this integration, merging $24 billion worth of different specialty systems, IT platforms, cultures, is it possible that even the best operator DNA isn't enough?
And that is the absolute core of the bear case. It's the most significant company-specific risk, execution risk.
It's
massive. Very few retailers have ever pulled off a pivot of this magnitude without serious integration delays, culture clashes, IT system failures. If they failed to integrate SRS and GMS successfully, it would be a monumental, capital-destroying distraction that could permanently impair their balance sheet and their ROIC.
So if that execution risk does materialize, where does the valuation fall apart?
It falls apart with the valuation disconnect. At 26 to 27 times forward earnings, the stock is at the very top of its historical range. And that range has seen the PE ratio go as low as 16 during prior troughs.
So there's no margin of safety.
There is zero margin of safety. It is already fully pricing in a perfect recovery. If execution fails, or if the macro environment stays tough, the stock is extremely vulnerable to a major correction.
And what if that macro failure happens? What if rates stay stubbornly high into 2027?
If the recovery just fails to materialize, Home Depot is left in a really tough spot. You've got 1% organic growth, high debt, no share buyback to support EPS, and now you're facing this renewed aggressive fight against B2B specialists like builders First Source on their home turf. That high valuation is essentially a fragile confidence rating.
And yet that confidence remains, partly due to governance. You have Ted Decker ensuring continuity and a board that's about 92% independent directors. That suggests they really vetted this strategy.
That independent oversight is key. It gives you confidence that this long-term, painful M&A strategy was approved specifically for value creation, even if it meant sacrificing key metrics in the short run. Ultimately, the high valuation proves the market is betting that Home Depot's superior operational foundation gives them the highest probability of navigating this incredible challenge and delivering returns when the macro environment inevitably improves.
So what does this all mean for you, the learner, watching this dramatic strategic pivot play out in real time? I think the summary takeaway is pretty clear. Home Depot is still a fundamentally dominant, highly profitable business that has deliberately sacrificed short-term financial returns. We're talking a plunging ROIC and a paused buyback to execute this defensive long-term pivot into the more resilient and higher growth pro market.
This is truly a show-me story now. The market has placed its bet, and now it's demanding results. And to judge whether that high-stakes bet is going to pay off, there are three critical variables you really need to monitor.
Okay, first up, track the pro ecosystem synergies. You have to look for specific data on pro growth. Management needs to show that the 4.6% growth they were banking on is translating into real revenue increases.
And look for updates on the integration of SRS and GMS. Is management actually executing the plan? Are they successfully cross-selling core Home Depot products like tools and fasteners through those new specialty distribution branches? That's where the real synergy is.
Okay, variable number 2.
Keep a close eye on interest rates. This is the primary external catalyst. If mortgage rates drop significantly, that coiled spring of pent-up demand for large remodels gets unleashed. The earnings trajectory could change overnight, which would instantly validate the bull case and probably mask any short-term integration hiccups.
And third, the clearest internal signal to watch for is the company's own all-clear signal. You need to monitor the timing of the resumption of share buybacks.
That timing is the explicit metric management has given you. Once they've paid down the debt, getting from that 2.5x leverage ratio to the 2.0x target, they will resume repurchases.
And that's the signal.
When that announcement is made, it will be the clearest, most quantifiable sign you can get that management is fully confident in the financial outlook, that the debt is under control, and that the pro strategy is on track to deliver.
The central argument in this deep dive is that Home Depot has effectively swapped one major risk, the uncontrollable macro risk of interest rates, for another, a controllable but absolutely massive risk of M&A integration execution. The market is betting heavily that management can pull it off, but the current valuation leaves no room for error.
So for you, the learner, the question is this. Will Home Depot's superior operational DNA and their proven execution be enough to successfully digest the two largest, most complex acquisitions in its history, turning a strategic sacrifice into a structural advantage? Or has the king of big box retail finally bitten off more than it can successfully chew?